the manicure, pedicure times kind of events. Things are spoken from the heart, and it's an entrepreneur gathering with, of course, investors and professionals. So that is one house rule. We will try and keep it as engaging as possible, but we will first allow the speakers to finish their conversations. If there's anything that you need to ask, I think Shantanu will kind of take your questions and direct it accordingly. So without further ado, over to you, Shantanu.
Okay, thank you. I think I have a mic, so I don't need that. But thanks everybody for coming on a Tuesday evening. I thought it was going to rain, but luckily it didn't rain, and the traffic, enough people made it, I guess, so that was good. So I'm happy to be back. I haven't been to India in 2.5 years, so it's been a long time. So it's really wonderful to be back, and the scene is happening here. And I was just telling Sandeep before, I used to live in India. I was here from 2007 to 2014-ish. And I think honestly I was just too early. I think from the scene from when I was here to where it is now, it's really grown exponentially, maybe 10x, and there's so many unicorns now. And when I was there weren't any unicorns, and I think the scene was just very nascent. And I think Thai has played a fantastic role in developing that. So I'm happy to be affiliated with Thai, associated with Thai. I think it's really great to see what's happened here. So as David mentioned, I'm a lawyer, corporate lawyer. I'm licensed in a couple of places, US in several states, California, Nevada, New York. UK, I did my first law degree at Oxford University in England. So through that I got licensed in the UK, and I'm licensed in India as well. And then I did the JD at Columbia Law School in New York, so I'm licensed in the US, and then I practiced law in London, Singapore, Silicon Valley, and a few other places. My main focus really is severalfold. I do cross-border work. I do a lot of U.S. securities work, and people ask me, well, what does that even mean? What is U.S. securities work? And I'll explain what that means in the context of what we're doing. India, I was here, so I understand the practice of law in India. The practice of law in India is really about foreign exchange controls. Money going in, money coming out. That's the number one sort of issue that I think a lot of lawyers and CAs in this country deal with. In the U.S., it's quite different. There aren't any capital controls in the same way as it is here. And so the number one issue is U.S. securities law. And it's around what the SEC allows in terms of issuance of securities. Here in India, SEBI deals with securities laws. So SEBI is typically dealing with publicly listed companies. That's not the case in the U.S., where the SEC is even dealing with fund issuances as well as privately listed companies. So private companies. So it's quite a different practice area. And also what I've seen in India is that for various reasons, which we can have a whole other seminar on, is companies in India have often what they call India externalization, where they flip their jurisdiction out of India for various reasons to the US, to Singapore, Cayman Islands, etc. And so for that reason, there's been a lot of interest now in India on US securities law, because anytime you're dealing with US securities, any foreign investor in the US, you have to deal with US securities law issues. So that's one thing. So I do fund formation, I do general US securities law. I also do a lot of work with crypto companies. And so I know we're in a crypto winter right now, but at the same time, there's still a lot of transactions happening in crypto, and a lot of crypto companies have moved out of India, but still focused on India. There's a lot of US securities law issues with crypto, either raising money from US investors or avoiding US investors, because that itself has a whole other can of worms dealing with the SEC. So many people do not want to deal with the SEC and don't want to deal with US investors, and so we guide them on that. And so that's kind of me in a nutshell in terms of the practice area. In terms of how I thought of this discussion and why I thought this was useful was really because of a movie that many of you may have seen called The Social Network. So I don't know how many of you have seen that movie or not. It's about 10 years old right now. But I watched it with great fascination because as a lawyer, the entire movie was about a lawsuit, which if you remember, there were two lawsuits going on. The first one was the Winklevoss twins, who sued Mark for basically stealing his idea, what they claimed, right? And so they settled it ultimately for $65 million, and they became crypto entrepreneurs instead of Gemini, etc. However, the bulk of the movie really was about Eduardo Sovereign's case. So if you remember, Eduardo was the other co-founder of Facebook, and at least from the research I did, he gave $1,000 to start Facebook, and then he got 34% of Facebook. However, he and Zuckerberg had a dispute, and Zuckerberg, if you remember from the movie, he got Sean Parker of Napster, And then he got Peter Thiel of, well, Peter Thiel was a well-known venture investor to put in 500,000. The result of that was that Edward Sovereign's stake went from 34% to 0.03%. So there was a lot of dilution in the cap table. And so that sort of interested me, that basically there was the rest of the movie, 2 hours of the movie was about that, basically, how he got diluted. And so that to me was the trigger point to understand or think about that entrepreneurs really, the cap table impacts them. And so what is a cap table? I think many people are, well, it's an Excel sheet. Yeah, but there's more to it than just that. There's a lot that goes into a cap table. How you have a cap table, how you don't have a cap table, really impacts your ability down the line. And the way I like to think of a cap table is it's a story of your company, of the history of the company, of the outstanding equity interests, and also the future equity interests. And I think it's very critical to understand in a company what is the cap table and how does it play against many things. I'll give you an example, and we can talk more with the venture capital investors. But one thing that I've spent a lot of time negotiating as a lawyer is around protected provisions. Many of you who've worked on these transactions, you often see protected provisions, right? Maybe you glance over them, there are 10 or 15 provisions that say that the company or the founders cannot do certain things, X, Y, Z, raise further capital, sell the company, hire a person over X amount of salary without a certain percentage of Series A, a certain percentage of A plus B or ABC. And so all of that drives to a cap table. So how do these numbers get picked up? They don't get picked up out of a hat. They're very purpose-driven numbers. And so whenever I get a new client on the company side, the first thing I ask is, I want to see the cap table. I really can't evaluate a term sheet unless I see the cap table and understand what the dynamics are and who's doing what. Because all of these power dynamics come into play later on. It's a little different in the very early stage context, but I've done up to Series F. And in Series F, raising $400 million, and it's incredibly complex to see a spreadsheet spread out over so many pages, and multiple investors with multiple rights and multiple liquidation preferences, and frankly, multiple egos. Because at that level, you have a lot of large investors at the private equity level, just some of the largest, Blackstone, you name it, the largest players in the world. It's very different than dealing with at a very young company at that level. Then they all want control. And so how you manage those control levers and who's got the leverage to do what, and there's some very sharp elbows as the company's successful. It's kind of like the Facebook example, nobody cared. In fact, when I was researching this, I had read that the Winklevoss twins actually complained to the president of Harvard University about Zuckerberg's behavior, and he dismissed it. Now you think, oh, this company will go nowhere. Clearly, when it became successful, then everybody cared about it, and that's what's going to happen is anytime a company's successful, all these legal provisions come into action, and I've seen so many times that founders are surprised when they realize that, wow, we just don't have any control. I was on the phone this morning with the company, and they kind of glossed over these numbers, and I explained to them that the percentage that the term sheet said meant that the one investor would control everything. And I said, you have 3 investors. You realize this one investor will control everything, the other 2 investors won't have any say. A, they won't like it, and B, you're at the mercy of one investor. Make friends with the other 2. You want to have the other 2 investors on your side, at least they can block those. And so this is something very important for people to think about in the context of a cap table, of how you construct it and what the levers are, the board composition, the exit rights, all of these things. And so I thought the best way to do this, aside from me talking about the legal issues, is to hear really from either founders or investors themselves. So we have 2 prominent investors here. Sandeep Murthy is a friend and client of mine. Sandeep, you can say a few words about yourself, Lightbox in the background, and then Minta from Bloom. I initially had Sanjay, so if you're confused about why it's not Sanjay now, it's because he couldn't make it, and Minton kindly stepped in. But maybe Sandeep, since you're here, you can say a few words about Lightbox and yourself and anything else before we get to questions.
Okay. All right, first of all, it's great to see people out. I think it's been a long time since that's happened. It's been a long time since we had people here in the office, so Thank you all for coming, and hopefully it's going to be an interesting evening. I guess as Lightbox, we started as a fund in 2014. We've got 3 funds. We invest in consumer tech businesses. Our current fund's about $200 million. We tend to invest in a small set of companies, 8 to 10 companies per fund, and usually go in very early and work with them and grow them. Some of the companies from our previous funds have been Droom, Rebel, Melora, Dunzo, Furlenco, Waycool, and prior to Lightbox, I used to work with a fund called Sherpalo along with Kleiner Perkins, and so that was from 2005. So I've been around for a while, so that's why Shantanu says an old friend, that means he's old. But from that time it was Cleartrip. We collaborated on Future Bazaar, which had its own challenges, and we can talk about cap tables and their importance there as well with the large conglomerate. InMobi, Map by India, Paymate, so those are some of the earlier ones. So that's kind of our portfolio and our approach. We'll talk more about those as well as we go.
Hey, hi everyone, good evening. So, quick intros. I am the finance head at Bloom Ventures. I have been in the Bloom ecosystem for about 10 years now. Bloom has a platform on services arm called Constellation Blue. So I was one of the founding partners at Constellation Blue back in 2013, and April this year onwards is when I moved into this new role. So being a part of the Bloom ecosystem from Fund 1, we are in our 4th fund now. This is likely to be about $220 plus million from 4. Ideal entry stage is pre-seed, seed, pre-series A max. From an entry perspective, we like to come in early, and like I think one common point Lightbox is work with these companies and get them to growth and onward. So that's about Bloom. A few companies. I think Fund 1, Grey Orange, DataWeave, Purple. These are Fund 1 companies. Fund 2, some of our great companies like Slice, Unacademy, Spinny from Fund 2. Fund 3 still in its 3rd year, so still coming along. And Fund 4, hopefully, we should be announcing a close sometime next month, and from there we'll see.
Okay, great. I have the mic, so I don't really need it. But I think there you have it. So these are 2 of the prominent venture capital investors in India, 300 million in AUM and 400 million AUM, so $700 million AUM right here. So very impressive, and the list of companies also, some of the unicorns or soon to be unicorns. So a lot of experience in this space. I think they're looking more at an earlier stage. As I mentioned, sort of Series A, B, or A. Both of you?
We're generally pre-seed.
You're pre-seed and you're A, B. So slightly different spaces in terms of where they're looking at. So one thing in terms of the cap table, I was one of the people here in 2007, very early. I was one of the, along with Sasha, helped with Mumbai Angels. I was their attorney who drafted all the documents. One thing I remember back in those days is you would go pitch to, it was so nascent, you would go pitch to an angel and they would say, here's 10 lakhs, I want 80% of the company. So it's like, how does that make any sense? So I think a lot of that was, frankly, just, the system that was so early, and also founders didn't have any options. I mean, there was very little venture money available. The case is totally different today. But in those days, I think it was different, and I think there was a lot of control on the founders, and not without good reason necessarily, but the problem is it sets up the cap table as it relates to this topic for failure. Because clearly the next round investor is not going to invest when the founder has 10% and the angel has 80%. It doesn't even make any sense. And so a lot of questions that I get asked in the context of cap tables when a founder comes to me very early is, what percentage should I get? What percentage should I dilute to angels? What percentage should I give to the C-suite, the CTO, the CFO, general counsel, any other people? And what percentage should I give to advisors? And so there's not necessarily a hard and fast rule, but there are some general industry standards, at least in the US, that's kind of become the norm. And then also I think you have to look at from the valuation issue. I think also becomes an issue is when you raise a lot of money, the founder gets diluted. And I think there are many examples where that's happened. So for example, we looked at the Zomato case. I only mention that because from the research I've seen, the founder ended up with 5 to 7% of the company left. And the same with Renew Power. That founder probably has 2 to 5%. And so there's this heavy dilution in some of those cases, and maybe that was the trade-off, high valuation, less founder control? Are there other situations you have the founders retaining a lot of control, maybe a lower valuation, or maybe it's a combination of both? And I think those are some of the things to think about. But I think as it goes to the panel, I think my first question is, in terms of the cap table, what are you guys looking for when a founder comes to you or a company comes to you and says, here's our company, here's our history, this is the cap table. What are you looking for? What's the ideal cap?
Okay, so at our stage, I think typically you would have had, probably one investment round done, which would be angels, friends and family sorts. So we generally get cap tables that are fairly balanced in that sense. We don't get extreme cases. We have had one-offs, and I think that's one important point. While the ecosystem has definitely evolved, founders have evolved as well, but there have been a few cases where, either, and not meaning wrong to anyone, but incubators, accelerators at times who end up taking, a lot more at the initial stages at times, right? So there's always a rebalancing of sorts needed, I think, and the way we look at it is, in fact, even where we feel at times that, at a seed we've kind of taken a much higher stake than maybe we should have. At a Series A, we're kind of a little okay in saying that, if a valuation is going here and there and dilution is getting affected, that should be okay, because cap table is an end state game, right? You don't look at a particular point. So when we get cap tables, founders typically have significant majority. The dilution levels, there is a market standard, the range is pretty broad, but the way that works is it kind of ties up to each fund's respective exit model, right? So from our perspective, when we enter 15 to 20%, or closer to the 20% is the ideal state that we look at, and that is the thought process behind that is simple. There's an in-depth analysis that happens on how a company would grow, what sort of valuation they will command. All estimates, of course, but these are backed by a lot of real-life examples, practical competition, various ways and means. You project a certain cap table and see that at your exit point, what will you be at? Right? Because eventually, in the venture industry, if we invest in 30, 35, we may get like 3, 4, 5 super hits, another 5 average, some that may not do well at all. So it's a game of probability at the end of the day. So each company that we hit, we have to project an end state outcome that is great. And based on that is how we make an assessment of what we should be at. So there are some factors that could command a premium. So let's say a second-time founder, there will be a certain premium because these people have been there, done that, right? The effort needed is a little lower. Whereas if there's a fresh founder, which we love, right? That's where we love to invest in. That there's significant time that's going to be involved. There will be effort. They may not hit a great Series A immediately, so we may have to back it with a bridge round or a follow-on round. So lots of those kind of factors go in, but the sweet spot is the 15 to 20% range initially, and at that point, what founders typically do, or what we also insist on, is have an ESOP pool of about 10%, and the rest is generally either with the other investors or the rest of the founders. But you want it to be meaningful for everyone.
So I'm not going to repeat that because I agree with all of it. I think that the thing I'll say is that it's more an art than a science, and it ends up being that conversation, saying, okay, if you take, and in our case, let's say you take 5 to 10 million from us, and you give X percent, do we think that X percent is going to grow over time to the point that we need it to, assuming a certain dilution? And if so, okay, then we're in a realm of reason to consider the investment. Now from there, whether that X percent should be X plus 5% or X minus 5%, it's now down to who wants it more and what's going to happen. And I'd like to say that we could write out a formula and everyone would be happy and we would look at the formula and we would say that's it, but it doesn't work that way. And I think we've now been through so many of these situations where, at the end, we're having a discussion where we're down to 2-3% difference. And either this business is going to be big or it's going to be nothing, and it doesn't matter. And it shouldn't matter on either side. But again, unfortunately, like I said, everything is an art, not a science, and everything has emotion in it, and so emotion comes in, and what does that mean about you as an entrepreneur long-term? What does that mean about you as an investor long-term? All these types of conversations start, and I think that that's kind of on the margin, and it gets used that way, quite honestly. Our process of investing in a company is interesting. You learn a lot about the entrepreneur and the relationship you're entering into through the process of the documents. And I think through the conversations that get held between, whether it's our legal team and them, or their legal team and our legal team, or even among the entrepreneur and us as the investment side, we learn a lot about what people care about, how they think about it, what their long-term perspective is. And one of the questions we ask often at the beginning is, what does success mean to you? And that's a relatively vaguely worded question, a very vaguely worded question, because there is no, again, answer for that. We're simply asking the question, what are we optimizing for? And I think in the cap table as well, that's a question as you look at it. I mean, there are things that I think Shantanu will point out and talk through here that say, you need to worry about these things, you need to care about those things, and I think that's hygiene. And I think it's very important that every entrepreneur understands that. But outside of that, it's a mechanism, I think, also for learning about each other in a defined way.
Okay, no, I think that's helpful. Let me just throw out some legal terms just so people have a sense of when people throw these terms, you understand what they're talking about. When I mentioned to you that when I get a transaction, either a venture fund calls me or a company calls me and says, hey, we're raising a round, I ask, is there a term sheet? And B, can I see the cap table? And often what I ask for is what they call a pro forma cap table. So if you ever heard the term, at least in the US we use that word pro forma, it means as a matter of form. So it basically means that when you look at a cap table, it has to be on a fully diluted basis. So fully diluted means that everything that can happen in the world of cap tables exists. So whatever things you promise to people, we show that dilution, right? And this is where it leads to some mistakes that you might have promised X something. And we've seen so many examples of people coming out of the woodwork once the company is successful and saying that, oh, I was promised this and I never got that, right? So those kinds of things people have to think about, that was anything promised, did any investor get a stake? The example of the movie, The Social Network, for $1,000 Eduardo Sovereign got 34% of Facebook, right? So obviously he was diluted down, that's what happened in the movie. But there were examples, I think even in Apple or something, where somebody else had given $500,000. I think there was a real example for a lot of money, and I think he got bought out at a very early stage, which now would be worth billions. But so the point is that fully diluted cap table is very important to understand, and when I see mistakes being made in cap tables, it's around this, where you have promised, the founder has promised equity to various people along the way, and there wasn't adequate documentation. Somebody will come back and say, I was promised this equity, or something around founder vesting is also another big issue that I often see, that you have some founders and then basically one of the founders quits or leaves, and then that founder still has the equity, and so what do you do with that situation? I think there's some real live examples. I'm not picking on any companies, but just because everybody here reads the media, I think housing.com was one example that I looked at from what I could read out of the media. They had like 7 or 8 co-founders from what I could read. And so I don't even know how that worked in terms of an equity distribution. And you had one, I think, founder that was, had some issues. Modape was another one that got a lot of media attention, where one founder left. And so, his equity, I think he had vested some, there was some that was not vested. The board asked him to leave. This is all public information that I just picked up from the media. But these are the kinds of things that you see in a cap table that has a lot of impact. And what happens is equity never vested. What happens to the rest of that equity? Who gets that equity, right? And so these are some of the things that I see in real life examples around cap tables. So I guess one question is, what mistakes do you see in these cap tables? I've laid out some live examples that you can point to without giving names.
Look, I guess having lots of shareholders is a challenge. And I think at an early stage in a business, if you can manage that, that would be ideal. And I know that's not always easy, because on the other side, we'll say that get friends and family to invest in the business and show that you have that ability to raise capital that way. So maybe get a few friends and family, not lots of friends and family. Because I think the moment you have too many people, then the idea of getting everybody together to pass certain things as you get bigger as a company, as you get more institutionalized, just gets more and more complicated. So outside of clear documentation and everything else that you pointed out, I think just managing the size of it just will ensure that it gets a little easier as you go forward.
Actually, this is the biggest problem that we've generally seen as well. And I think the one solution or the one thing that I've seen work well is where founders have not control necessarily, but good rapport, that ability to pick up the phone and talk with each of their shareholders, right? So we are fresh from a few exits in the last 2 years where people don't have a clue on who this individual is or how to reach out to them, right? And when you have acquirers that are listed, let's say likes of Reliance, for example, right? They, even if you have one shareholder with a 0.5% stake, one may say that how is that, how does that matter at all? But you have listed companies on the other side which have their own compliance. So we've had transactions that actually get held up for 2-3 months till some of these are not closed. So every shareholder matters, whether that's 10 shares, 20 shares, whatever it is. So yeah, one, I think have that, be in touch with all of them in some form or the other. It could be monthly, quarterly, whatever works best. I think that's one key. And there are workarounds. So when you have like a group of friends and family, let's say that have come in, a group of angels coming in from one particular angel who's leading, try and build in mechanisms like power of attorneys, this, that, so you don't have to deal with so many people. I think this is two, three things that worked well historically.
I think that's very valuable advice. I mean, one thing that I saw recently was I worked on an exit, and there were two interesting things about that exit. One was there were a lot of angels, early investors, and what the founder had done, I think very widely, was put them in a specific SPV. In that case, the company was a Cayman Islands SPV, so we were able to move those founders. It was US oriented to a US LLC, but in India, I guess you could put them in an LLP. But that's one advice. If those people agree, then you put them in one entity, and therefore on the cap table they just show up as one LLP, and maybe you let the biggest investor of that drive the decisions. But again, there's a lot of political issues as to who's going to call the shots. But at least in that example, it did work. And I think those investors were happy because they were able to stick around longer than if they had been forced to exit earlier. I think so that worked out. The other point that what Mithun said was, it is actually very true. I worked on another large transaction, a Series E, $300 million. We actually flipped the company from a India-based, Chennai-based company to a Delaware structure because the company was going to raise $200 million. And we actually had a number of angels at the India level, and it was very complex for them to flip. And to Vince's point, it took months, and ultimately the investor got tired of waiting, and basically, you need to get on board with this or not. And so we eventually set up a new Delaware C Corp with an India sub, and we frankly left those angels in the India subsidiary as is, and basically tried to deal with them later on. And so it kind of had negative connotations for them, but that's eventually what had to happen, because it was just too difficult to deal with them. And maybe it was not only their fault, partly, I would say, because when you were flipping a company from India to US, you have your own complications, and so they had issues around that, and they were individuals and not companies, so they had a lot of, it took them time to get advisors and all that, so that's what I wanted to, that actually segues very nicely to the next question, is that a lot of times these cap tables and what I'm talking about also relates to jurisdiction and incorporation. And so, what I do a lot of is work cross-border. Indian companies, U.S. companies. Delaware is usually the preferred location for U.S. Cayman, I do a lot of Cayman. Singapore, I've done a few. Mauritius, I used to do. I've not seen Mauritius in a while. I think it's not as popular as it used to be, but overwhelmingly, these U.S. investors prefer Delaware and Cayman. India to some extent, but I think the challenge with India has always been the exits, particularly for U.S. investors, because there are a lot of issues with, particularly with tax issues when you are dealing with U.S. investors investing in an Indian company. Then I've seen them withhold tax for 7 years. The buyer has said, well, we're just going to withhold tax for 7 years, and so that's not acceptable to a buyer, to a seller. And so these are some live issues I've seen in cap tables and transactions. But maybe talk about, are you looking at pure Indian companies? Do you do any other structures, and what impact it has?
Look, I guess the exit problem is more a market problem to begin with. If we had fantastic exit channels, whether it was IPO or M&A, I think everyone would solve these issues very simply. Now, that being said, the exit problem is not, we should be optimizing, we should be considering, but I just want to point out the fact that the reason why we're not getting liquidity is not necessarily for structures. I think the market's taking time to scale. It's coming. I think that's what we've been selling as a story, and so in general, I think we're getting to the point of businesses scaling, and so that should start to get resolved. Now, That being said, I think that overall we found that being incorporated in India works. It works for us in general. If the IPO markets are good, then that'll work even better for us. And as long as that in India, I don't really necessarily see how it's going to help us enough. Because now at this point, there's a tax treaty between Mauritius and India is pretty much gone. So therefore, you're going to pay the tax here. You're going to get out with that, and all our investors are aware of it. So at this stage, we're not forcing the factor. Now, you guys might be coming in an earlier stage where you have some more influence, but if we've come in and they're a US company or a Delaware company, a Singapore company, or an Indian company, it's irrelevant to us. We'll just go with it, and then we'll see where the business takes us.
So a little different for us, and I think that's a factor because we're largely an Indian fund. So we do have a lot of offshore investors, of course, probably a significant majority, but at the end of the day, we're an Indian fund and we have all Indian funds. So if you go to any AIF, technically, there will be some restrictions because we're only allowed a certain amount of investments outside India. But that aside, I think from a decision perspective, business has generally driven the decision. And wherever business has not driven the decision, we've generally had issues. So to put some examples to that, if let's say it's a B2B SaaS, right, which may end up having large clientele outside India, for example, or crypto, for example, which has issues, regulatory issues in India, right? These kind of companies may choose to incorporate outside, and we don't really drive that decision in spite of having that ability to influence some of these things. I think we generally rely on the founders to make the best call. Where it doesn't work for us, we probably will not go ahead, but we'd rather let the founder take the call and then follow on that lead. But yeah, business decisions, I think, and wherever, so two instances, again very recent, where one company did go through the restructure and we've had a PE investor come in and said, even though the PE investor is sitting outside India, foreign fund, they've actually asked this company to re-domicile back to India because of precisely these issues. That they may end up having tax issues, they may end up having regulatory issues. So these are companies that may have flipped thinking that, yeah, maybe, this will help, but they're still largely Indian client driven. They're still Indian entities from a substance perspective. So I think as long as it's backed by an underlying thought process, I think it's okay to incorporate wherever it suits well. But yeah, otherwise we've not had any challenges in India at all. And even from a fund perspective, maybe unrelated, but a lot of our investors, even sovereign funds, have chosen to invest in India direct instead of coming through either Mauritius or a gift. So I think from that perspective, we're pretty much okay.
I'll just have one other anecdote. So we actually invest in InMobi as a mobile ad network for the Indian market when we invested. This was in 2007. And our contention at that point was lots of mobile phones in India, mobile advertising will be local, there's an opportunity to build a business. What we found as we invested and grew the business is more and more of the revenue was outside of India. Whether that was the platform was useful in markets first in South Africa, then in Indonesia, then we got to Europe. And as it went that way, we suddenly realized that the business was largely outside of India. And as we raised a very large round, let's say 2010 or so, with SoftBank, we moved the company to Singapore because at that point we were generating more of our revenue outside. So there are cases where, as you pointed out, the business will drive it, and that was an example where the business did drive us to move outside.
Yeah, I think these are great anecdotes. I mean, I've seen, there's no right or wrong answer really, but I think a lot of it is, I've seen this trend in B2B SaaS companies, as people pointed out. They tend to have a US incorporation. The company I mentioned that flipped and raised a significant large amount of money was a B2B SaaS company, which had a kind of a back end in India, but the customers were largely in the US. And so I think for those types of companies, it probably makes more sense to be a product that customers fresh. I think the example was Fresh Desk, which listed in the US. So that was a good example of an Indian company flipping to the US, B2B SaaS, listing successfully in the US. Disregard the current share price, but whatever they listed, it was a success. And so that's an example. However, you see other companies here which are really more domestic focused. I think they've listed in India, Zomato, again, disregard the share price, but they listed successfully in India. Despite, I think they do still have some interest outside of India, but I think those are some of the drivers for what we see. But I would say the cap table issues are largely similar. It's not that they're any that different, US versus India versus Cayman. I think a lot of these things cross the spectrum of what I mentioned, founder dilution, etc. I think India in some ways, it's a common law jurisdiction based on English common law, and so therefore a lot of it is under English law anyway. I think the differences really are that there's much more exchange control issues in the US, which we don't have in a Cayman company, and we won't have in a US company. So that's the distinction. I think that the cap table issues are probably very similar between US, India, Cayman, all very similar, and between investing and too much dilution. I think the other thing I see is around valuation is a very big issue in the last few years post-COVID, or during COVID was actually, much to my surprise, it was a boom time. I mean, I think everybody here kind of stay-at-home trend and everything else. A lot of companies raised capital. It was a good time, despite the external environment with COVID. The last since the Fed has started raising interest rates, stock prices are down in U.S. and India, and then of course valuations are down. And so I think those companies that raised earlier are now raising down rounds. And I've seen this live, that I have clients or I have investors who are investing in companies that raised previously and now they're facing a down round. And so these are live issues. One of the things that we can talk about more is anti-dilution. A lot of times this is a theory, and now I've actually seen it become a reality that somebody raised it $100 million 2 years ago, or in the middle of this boom period, and now it's hard for them to raise $50 million because their numbers haven't worn out, or they just, especially in the crypto space. Let's say there was a lot of exuberance in the crypto space. Crypto's at the lows, and so people raised a lot of money at a high valuation. They may not get that valuation today. And so how do you address those very real questions of anti-dilution triggering? Because what I just mentioned to you about the earlier example where those protective provisions, what's happening that, and what I saw in a very live example was the current investors were basically using the protective provisions to their advantage and saying, you're not going to raise any more money until our anti-dilution protective provisions kick in. And therefore we will get more around. Now, the question is whether that's a quote poison pill. That those of you who've been around, the 80s, you remember the poison pill that was invented in the US, and what that meant was basically extreme anti-dilution. And so that basically triggered anti-dilution to the point that acquirer would walk away thinking, this is crazy, I can't invest in the company. So there's a kind of a fine line between triggering the anti-dilution and activating it to such an extent that basically kill off any future round investor. But these are very live discussions in terms of valuation and next round and the impact on the capital. I think the other thing I would talk about is kind of legal instruments, and I'll ask the panelists about this, but different types of legal instruments. I think one thing that I have seen the last few years is the emergence of safes. And safes, when I started my practice, there was no such thing as a safe. In the last few years, I'd say, because Y Combinator really sort of pioneered this safe. And a safe, for those of you who don't know, stands for Simple Agreement for Future Equity. Very common now in Silicon Valley and also in India, to some extent. They can talk about the Indian context, but essentially what it does is when you are in an early stage company and you yet don't know the valuation, or you cannot agree on a valuation with the investor. And the reasons why you cannot agree on a valuation are many. It's not simply because you don't want to do the work. It's because the product isn't there yet. You don't have enough of a customer base to develop a thesis as to what's the valuation offer. In a later stage company, you can determine based on the extrapolate based on the revenues of the company, based on public market valuation or comps, comparables, peer groups, that this is the right valuation. In very early stage companies, it's very difficult to determine that because you're still determining PMF and still product market fit and still determining the product itself. And so one way to do that in the old days was the convertible note. So before 2012, 15, everybody was basically the right way to do it was a convertible note. So a convertible note is a quasi-equity instrument that basically gives the holder the right to convert into equity at a discount to the next round of valuation. And that's been the traditional way. And the interest as well. Usually in the US, it was 5 to 8%. That's probably right. Interest rates have gone up, so maybe that's changed a little bit. But that's what people typically do in a friends and family round. Usually you'll offer friends and family a convertible note. In the last few years, you've seen safes, and what the safe is for the founder, it's probably even a little better because it's not a debt instrument, so it's a pure quasi-equity instrument. There's no interest component. It just converts at the next round, either at a particular valuation cap, or at a discount to the valuation. There are various measures or ways you can kind of maneuver around that. And I think the environment was so good for safes in the US that the joke was, if you're a crypto company, you could literally raise a $500,000 safe and go skiing for a year in Lake Tahoe and come back and nobody would ask any questions what you did. And so that was kind of a frothy environment that we saw in the last year. I think it's totally changed now, because now you have a safe and you need to, if you have a safe, the company needs to basically raise money in the next year and a half. Or it needs to convert at a set valuation. I think those are some real issues that I've seen that basically people raised, in the last 18 months at a high valuation, a lot of exuberance. They're not able to meet those valuations now. They're going to get severe dilution impact or unhappy investors. And so these are some live things. But maybe I want to talk about the panelists about their issues around in legal. So the last thing I wanted to talk about was, before I get to them, was liquidation preferences. So what I've seen in liquidation preferences during the standard is 1x liquidation preference. And during the NASDAQ bubble, I saw 2 or 3x liquidation preference after the bust. So 1999, post that, 2000, there was a lot of that. And I think it was unfair to entrepreneurs. A full ratchet anti-dilution, 2x liquidation preference. So kind of the pendulum kind of swings back and forth depending on the cycle of the economy and the general venture capital funding situation. And so around liquidation preferences is often, when you're constructing the cap table, it's very important also to understand the liquidation preference stack. And so when I was telling you about this $400 million transaction we actually did create a spreadsheet, and we mentioned the liquidation preference stack. So at this much, $1.5 billion exit, who's going to get what? At a $2 million exit, who's going to get what? And so it becomes more and more complex when you're dealing with a late stage company, especially when you're raising rounds of capital, and it becomes a question of last in, first out. So if you are the last in investor paying the highest valuation, you should be first out in terms of your exit potential and your ability to exit, and maybe your liquidation preference, that you are highest on the stack versus first in, last out. Usually it's last in, first out. That's the typical way. But those are some very live discussions, and transactions often get really heavily negotiated based on the liquidation preference. And I think even more interesting to the founders is what they're left with. And sometimes it's kind of a surprise to them as to what's remaining for the founding team. Especially in a very late stage transaction, there's all kinds of things. And then you had a down round on top of it. And so, it's a long-term game, and it's not necessarily any doing of the founders. The economy and the general environment also can have an impact. But let me talk about some of the issues around different legal instruments. Usually US, India, whatever you see.
Yeah, I think you hit a lot of topics, and so I'm gonna take a few. So look, I think one thing to keep in mind is I think fear and greed are the two emotions that play in general when investing is going on. So it's important to understand where you are in that cycle. If you're in the greed part of it, take as much money as you can, because people are trying to give it, and don't spend it. And I think that's where Shantanu was talking about anti-dilution kicking in and everything, was because we were in a greed cycle. People gave high values because they wanted to get into stuff, and the entrepreneurs should recognize that you're in a greed cycle. Your business is probably not yet worth that much. So be conservative with how you spend it, grab the money, but then just relax. And then avoid, because those clauses are going to come. Anti-dilution is going to be there because the person coming in is going to ask for it. And as much as greed may exist, if I'm paying a ridiculous price, I'm probably going to ask for multiples on the liquidation preference, which did happen again in the past couple of years. We are in a fear cycle right now, so it's unlikely that any of that's coming about. So in all likelihood, take as much money as you can, and also be very careful with it. So I guess the fundamental idea is don't burn the money unless you have a logical method for doing it. And I think if you do, then a lot of these things get managed. And it's not to say that you can't ever hit that problem, and that's what Shantanu was saying. It was a theory for a long time, because I think there was perhaps more respect given for the money that was raised, so people were more careful with it, and therefore you were able to sort of grow into your values. And also there was more care given on valuations given. But when greed kicks in, that whole thing shifts. And so I think that's how we've seen that play out. I think that as an investor with new investors coming in above, I would always say that we fight to not make things complicated. The more complicated those things get, the more interests become divergent, and then it becomes very complicated. And I think the thing that we try to make sure exists all the time is an alignment of interest. And so as more and more terms come in, as more and more things play out, I think that becomes harder and harder to know that your interests are always aligned. There are things like, we will give you a bump in value if you meet a revenue target, or if you meet a profit target, or if you do this. People do unnatural things to meet those objectives, and then that changes the alignment of interests. And so we tend to avoid things like that. As attractive as it might sound to an entrepreneur, I can get a 50% jump in valuation if I hit that number. I'll hit that number for sure, no problem. World changes, they do unnatural things to hit that number, they burn too much. All sorts of things go wrong. So I would say keeping things simple and being very careful with the money is probably the best way to think about those things.
So a slight extension to one of the points he was making. So we actually, back in 2020, I think we did this assessment on complexity when entering into a company. So complexity in all forms, right? Negotiations, how things have been, how smooth have they been, or how not smooth have they been. When we looked at the companies that have performed well, the one common trait amongst all of them was the entire process was a smooth process. Right? So, like he was pointing, I think the one key thing is coming together. It is a partnership at the end of the day. So, squeezing at both ends may not work. I think it has to be collaborative from a thought process, and that has always worked well. I'm just coming out fresh off a conversation today morning where one of our investment team members has told the founder that you want to raise the valuation by $2 million, no problem, because the $2 million mattered a lot to him. For us, it was a 0.07, 0.08% dilution, which didn't really matter. I think these small things play a big role in ensuring that the relation starts off smooth. And the one common trait in the companies that didn't do well is where there was optimization at either ends, right? It's not necessarily founders. Optimization at either ends for any reason doesn't generally kind of work out well. So I think that's one. On the instruments, typically we like pricing rounds. We don't do these convert rounds once companies come to us. And I think that will be the case with most institutions. Where these converts come in is when there are investors who come in earlier. So one big change that we've seen in the last 5 years, 6 years is mainstream or rather venture is now slowly moving to mainstream investments as well. Right? You have a lot of the folks that traditionally invested in real estate or listed stocks are now seeing the opportunity here. So when you have that kind of money coming in, supply is going up, but not necessary that they know how things work. In those cases, we've seen some of these instruments work really well, where you don't know how to price around or don't anticipate what it will look like. And then those are the typical angel rounds, friends and family rounds. And then after that, it's all institution. Where we would have is in bridge rounds in our companies, where there could be a difference of opinion on the valuation. There we say that yes, the company needs to be bridged, but there is a difference of opinion in valuation. Let someone else who comes in at a later stage come and validate whatever the valuation is, but let's go ahead. So I think we use these flexibly, but a bulk of it would generally be on fixed instruments, which is equity preference and liquidation preference. So interesting point, I think, will not ever come into play other than in bad scenarios. Right? That's where it gets to, and these are generally the toughest scenarios. So there have been instances where we, even though there is a liquidation preference on record, we may not be able to enforce it for various reasons, right? And likewise, there have been instances where acquirers also come and say that we'll return and meet your liquidation preference for investors, but that's about it, nothing more than that. So I think that's where it comes into play, and we've also come down to that point where 1x is what we've seen as generally acceptable. Definitely a different a difference from what it was earlier, but yeah, that's where we are right now.
Yeah, I mean, I think a lot of the experience and kind of their perspective is driven from what stage of investment you're in. I think both of these investors are I guess you're a little bit earlier stage,
Yeah.
Series A, and Sandeep is sort of Series A/B. When you look at, and a lot of what I talked about really was, and they're right about the interests being aligned and sort of everybody being on much more friendly terms. I think that's a fair point. But when you're dealing with much larger rounds, and higher valuations and many more parties, and as I mentioned earlier, much larger investors, including some very large private equity funds, and then it becomes much more complex. And then frankly, it's less friendly. And so that's where I wanted to just kind of bring that attention to that. This is at one stage, it's probably a little friendlier because we don't even know if the company's going to work out, right? Frankly, you mentioned there's a certain percentage of the companies that's the venture business, it's a game of probability, so you're at some point you're negotiating on an eventuality, you don't know if it's going to happen. So I understand that, but when you're dealing with a company at a larger scale and when it's kind of proven out and the numbers are big enough, then the elbows become sharper, and a lot of these dynamics come into play that I mentioned to you around thresholds, for example. There's a lot of interest that I see in negotiation. I worked on this company, I mentioned, Indian company that flipped to the US. The earlier investors were not investing because they were much smaller investors. At that last round, we had some of the largest private equity funds in the world, including some sovereign wealth funds. Some of the largest ones in the world were investing, so $1 billion, $2 billion plus kind of funds. And then at that point, the earlier investors got diluted. And so at what point do they have a board seat? At what point do they have any rights to information rights? At what point do they have any protected provisions? And so these gentlemen might have seen that as the companies they're investing in do larger rounds. So from their own perspective, they will have to manage their own positions in these companies. And I get called a lot from investors to how do we manage our position in these companies. For example, one investor I was working with, they were very concerned about losing their information rights because with the information rights, they needed to report to their LPs. And at that point, they were being diluted below, I think, 3 or something percent, significantly below, I think, the 6% or 5% that was agreed on. And so they were concerned about their information rights. How are we going to report this? We're basically going to be blind to the company. And so we were able to negotiate a side letter that was not in the documents, but that gave the investors some rights. And luckily, I think in that case, the relationship, to their point, was very good between the founder and the investor because they'd come in very early when the company really hadn't proved it out. So in that case, it really worked out. But when you do have some sharp elbows is at a later stage. And frankly, it's also cultural. I'm dealing with an early stage investor now. That investor's out of New York. Very different perspective to California investors, which are probably a little more venture-oriented. New York investors are much more private equity-oriented. I think it also, frankly, depends on the law firm you work with. Not pulling up blood, but Silicon Valley lawyers and law firms think differently from New York or London law firms. Very, very different. And maybe even in this country, the types of law firms that are venture-focused versus private equity-focused, you get a very different response in terms of negotiation and disclosure. We were working on a transaction where for a Series A transaction, there was a very extensive disclosure schedule that would have taken the company a month to prepare. And so at some point we had to get the law firm to drop it, saying we're just not going to get this deal closed. It's not even appropriate for a deal this size. So there's lots of negotiation around that. So I think, do we have time for questions? I mean, that's the next thing we should get to before we have tea and whatnot. So we have questions here. Anyone wants to ask? Gentleman here in the white shirt.
Hi, I'm Alok Parmar. Want to speak on a mic?
Just checking.
I can. I'm
We can hear you.
Yeah, go ahead.
So we hear a lot about this various types of equity shares and types of shares that are basically there. Do any of those motivate you or demotivate you in terms of the investments that you wish to make? You know, if there is already something given as preferential shares to somebody or any other kind of, the instruments. Does that make a difference in your decision-making process?
So I think in the India context, it's largely settled that investors, financial investors, will typically have preference shares. So we do take a nominal number of equity shares, but generally it is always preference, and nobody has any concern on this because there is no flip side to this for anyone other than the liquidation preference. Right? That's the only one thing that preference share helps with. But I think everyone recognizes that as financial investors, that will be a requirement because there are obligations onward obligations we have to our investors. But yeah, we've never really had to decide on an investment whether to make it or not based on an instrument. It's generally never been an issue so far. In the US context, maybe Shantanu can touch upon that, but there is this whole, voting rights versus your shareholding being different, right? Where a founder may have a lower shareholding but majority voting rights. Now that as a concept, while I think law does allow that in India in some way, but people have not implemented it as yet.
So in an Indian context, it is essentially the जो अपना preferential or equity shares, that's about it, and there is nothing major, no major difference in any other kind of a setup that you can do, like you said.
So there are some so a little technicality, right? So let's say in an anti-dilution, for example, right? If as an investor we hold only equity shares, getting additional shares against equity is not tax efficient. You can't get free shares in India. Right? Whereas if you have a preference share, there is this conversion ratio. Again, there is a variant for resident investors, non-resident investors. But anyways, we use that lever to then say that, okay, fine, this is how instead of 1:1, we'll say 1:1.5 is what we'll get, let's say, depending on what the calculations are. So that's one. The other thing is, we have had instances of ESOP issuances. So let's say if a founder is diluted significantly at a CDCB and you have to get him to a certain level, that this is again another tool that is used that, maybe, give him some shares, but if some people don't have to, then change the conversion. So tactical reasons, but otherwise this is pretty much how
in India, so there is no preference per se. It is essentially equity and preferential shares that the market is.
So one quick point to add to your point about differential voting rights. So it is possible in India. And what I've seen it useful is when you're dealing with a restricted sector. So there are some media sectors, for example, where a foreign investor can only have 26%, or some, that list is narrowing now, but there are some still sectors where there's some restriction on FDI. And in those cases, an investor, wants a percentage, but they can only have up to 26%. How do they deal with voting rights? And so that's where you get differential voting rights. So I've seen that being used effectively in that case. To your other point about kind of what founders have, what they call super voting rights. So that's correct. You do see it in the US. So there are plenty of examples of Facebook being an example, Google being another example, where founders, I think it's 10-1 in some of those companies where the brand or page have those kinds of rights. Even if they have 10% of the company, they have much more voting rights. And so they were able to negotiate those rights. I wouldn't say it's very common. I get a lot of founders trying, but usually the VC is not going to buy it unless they have that kind of a thing. It's very, I don't think it happens in India, but other jurisdictions are trying this out. I think the UK is just now allowing this because they want to promote London as a place to also list stocks, but traditionally it's with the US. Okay. So, anyone else?
Thank you.
Just to follow on, as you said, for the anti-dilution protection, you would prefer preference shares because you can't issue free shares in India. Of course, you can issue shares at par, but then there's tax implication as well, right? Where it would be taxed in the hands of the...
it becomes practically difficult.
Yeah, because you can issue at par, but then there would be a tax implication.
There's one other part to that. One is the economic benefits that come with preference shares. The other are the operational controls that come as well. So we take certain affirmative rights that allow us to ensure that, let's say, certain hires we have a say in, certain fires we have a say in, certain expenditures, all of which get captured as well as part of that preference share. So economic rights and operational rights come with it.
I have a question on the equity preference, right? My name is Hetal, and hi, my name is Hetal. I have a question on link preference. Basically, you mentioned that the investor who comes in last at the highest rate of valuation would be paid first, right, in terms of link preference. But what if the valuation is lower than the first investor? So, for example, if I have an investor who came in at 100, but my second investor or the third investor came in at say 30 rupees, would the link preference still change, and would he still be in a position to demand a link preference over the first investor who came in at the highest valuation?
I'll start with it. I guess this is where the anti-dilution that we were talking about before kicks in, right? So The first guy came in at 100, second guy came in at 30. First guy's upset. He says, no, I shouldn't have paid 100 if that guy's paying 30. We have to adjust my price. That adjustment can happen in a variety of ways, and now Shantanu did the math on it, but there are different forms.
Even to the ESOP, because this other company I had mentioned to you where I had worked on where there was a large exit, we actually had that exact scenario happen. High valuation, then the economy turned, then down round, the founders got diluted too much, and I think basically what happened then was the VCs realized this, and before they could get an exit, they wanted to incentivize the founders, and then a management ESOP was actually created. And so in that case, it actually worked out, and eventually did get a big exit, so it actually worked out for everybody. But in that case, the VCs actually were cognizant that this is going to be an issue when the founders have diluted too much, because we can't even hire anybody because we don't have an ESOP left. And the founders will also basically get bored and leave. And so this is a problem. You know, a lot of this is human interaction that goes on. You have time for one more? One or two more? The guy in the red?
Okay. You guys talked about B2B SaaS startups. Right? Who are flipping their structures, and then you investing into them. So then you invest from your India fund, or do you have a separate fund?
We invest from the India fund.
Okay.
So we're allowed 25% of our investable corpus where we can invest outside India. So we invest out.
And those founders are in operating out of India, or they move to US, or?
So I think that's where. So again, maybe a slight technicality, but the essential from a tax perspective where things get stuck, right, is if you don't have substance. If you're, let's say, if you're headquartered outside India, but you don't have substance. If everything is India technically, that's where you'll face a challenge. So preference, yes, will always be that at least one founder or some sort of control has to be there. Could be founder, it could be CXO level employees, but that the business should drive. It shouldn't be like a formula. So like for example, we have a space tech company, Pixel, right? Now this company comes from Techstars, this, that. So, you know, just space tech as an industry is evolved there. It's still building here. Right? Now, for them to get the right value for their company, to get the right set of customers, vendors, it just naturally made sense to set up in US. And because they're so operationally heavy in US, naturally their team build-up has also happened in that way. So there is an India entity as well that works for all the back-end tech, etc. But if naturally you're doing that, I think it's okay. This company that I talked about, where we've been asked to bring it back, that's a company where there is just an HQ and maybe one or two people, but no real substance. Now where the issue is in exit. So we had an acquisition recently where US headquartered with Indian subsidiary. There is this concept of indirect transfer provisions in tax. Now what that simply says is that if more than 50% of your value is derived from India, even though you're a US headquartered company, for all tax purposes you're deemed Indian. So the acquirer took that view. They had tax advisors, etc. Took that view and they had withholding tax, like you were saying. So we had withholding tax there, even though technically we shouldn't have because it was a US domiciled company. So this is where then it falls into the trap at exit. You'll not really realize this while you're running the company, but eventually, if there is no substance, there are these kind of issues.
Okay, the gentleman here.
Any more questions?
Yeah.
I got preference for standing up. Okay. Here's a situation where a startup is raising funds for the first time, and the kind of commitments they're getting is far more than the desired amount. Now, some investors are saying, okay, give us the rest of what we want to invest in the form of safe notes and some discount to the next round. Can an equity round and a safe round like this, can it be done simultaneously?
I mean, I've not really seen that. I think that's a little unusual. The normal pattern is safe. So why you do a safe is because you don't have a valuation. Now, if you're doing a price round, you have a valuation.
So people have offered at a very low valuation.
Okay.
People jumped in. They said, okay, please take more, but maybe not at this valuation.
I see. Okay.
But give us safe notes.
I mean, legally, at least on the U.S. context, it's possible. I wouldn't say it's capable. These
But
guys-
it is. We've actually done a couple of that. And simple, by the time we closed our investment, a lot more demand got generated. And the founder didn't want to let that go off. So waited about a month or so and took it in form of a convert mode. Doable. I don't think you can time it together. But maybe one after the other.
No legal provision which says you can't time it together?
I don't think it's about legal. I think it's just optics that may lead to legal challenges. When you're saying that, okay, fine, I'm issuing shares at a certain price, at the same time I'm issuing a convert mode, then I think justifying that kind of becomes a problem. But a slight gap, a month or so, and I think it should be okay.
Thanks.
I mean, I think it is a real problem to what you pointed out, to what they call the cheap stock problem. So oftentimes I get asked to flip a company. So we flipped a company to the US and then a month later they raise a $10 million, round. So how did the company go from 0 to $30, $40 million valuation in a month? And so this is a question that, the IRS possibly, I guess, could ask. The US is a little more flexible environment, but still it does become an issue. And the tax advisor in Europe could advise more on that. But I've seen that as an issue. And then when you issue to founders also, how does that work? The founder issues, because they're also, maybe they have the Indian company for 2 years and flip to the US, brand new company, founders get stock at a base valuation, a month later at a high valuation and issuance of shares to an investor. So these are some real consequences.
Hi, my name is Anil. I am from Cap 70 Angel Network. Most of the challenges that we face, a lot of investors are there with low ticket size. And generally the cap table goes up to 50, 100 people also. So as an institutional fund, do you prefer such kind of cap table, or another model is where we form a separate legal entity and then that invests into the company?
You can share your views. I'm going to be honest about this. Large cap tables are definitely a big problem. It is not a preference. And I think the way angel consortiums have cracked it is the angel fund. I think that's a great mechanism of cracking it. I think that we see as very positively because you're dealing with one person and you're not dealing with so many people. So if you're an angel network, I would recommend moving to that as soon as possible. Yeah. So I won't say that we've said no to companies that have large cap tables because we like the idea, like the founder. But then there will always be this thought at the back of the mind that, how do you eventually get into a smaller cap table, right? Do you do secondaries at discounts, start gradually getting into a slightly concise cap table? Large cap tables are a problem for everyone. Angels, founders, institutional irrespective.
I'll just say one thing that gave me a thought. That one way to game it, if you want to get a secondary, is keep a large cap table, and then you'll force people like us to come and buy it.
Actually, that's a very good point. And so what I saw in the other company that I mentioned, the founder actually shepherded everyone into one LLP or LLC in the US. I think that maybe people protested earlier, but the effect was that the investors actually didn't buy them early on, because on the cap table it showed as XYZ LLC and there weren't too many questions asked. If then showed up as 15, 20 people, a lot of questions would have been asked, and the VC would have said, oh, we're just going to buy these guys out. Eventually, they did get bought out, but at a much higher valuation, and so those investors were actually happier, despite their earlier protestations, so it worked out in their favor.
All your stories are so good.
We like happy endings. Bollywood movie type. Huh?
So as a follow-up to the same question, how would you perceive an LLP being on the cap table rather than a few angel investors? So if you have a few angel investors supporting you early on, who might be professional angel investors, I mean, not typically angel investors, but maybe like a doctor or something like that, and who are investing in a health company. So would you prefer them being bunched under one LLP and just one person on the cap table?
So I think, see, on the angel investor side, I think there are what we would say value additive angel investors to the company, and then there are angel investors or financial investors, right? So where the challenges typically are is the angel investors who are financial investors, because they are far from the company. See, these value-additive investors are generally in touch with the company. They've invested for a certain reason. Founders are in touch on an ongoing basis. So whether those 3, 4, 5 come in direct or through an LLP will not make too much of a big difference, is my sense. The other part is where it becomes a challenge.
Thanks.
Let me know when we should wrap up.
I think so.
Okay, well, we have other things, networking and tea, so happy to do it, we can host at our event. So thank you, Sandeep, for being so enthusiastic and responsive. We didn't have a second hesitation to host this, so thank you very much. And Bloom, of course, I have a long friendship with Bloom, and so thank you to those guys, and thank you to Ty for agreeing to host this, and everybody else, the support staff and everybody else who helped with this. And thank you all for coming here. I think hopefully we seem to be full house, people standing outside, so it's like a rock concert here, a nightclub. I never expected this from a Ty event, so thank you. Enjoy.
So folks, I would request you all to move out so that there's more space here. We're not going to let these people go away, so we'll